All right. Good evening, everybody. This is Jessica with Startup Grind Orange County. Tonight we have a great conversation. We are going to be talking to Mollie and Shaheen. Mollie is with Must.Love, which is a brand that has consumer products, directly consumer products. And we also have Shaheen, and she is an attorney, local attorney here in Orange County. She is actually the attorney for Must.Love. So they are going to do a case study and use Must.Love as kind of a basis on our discussion tonight, which is cap tables and dilution. So that way you have a better understanding of how that whole context works when you are having your business and you need to give out equity, or you want to give out equity to investors or your founders, and all that being a scaling startup you have to look out for. So to give you a brief introduction, Startup Grind is a global community for entrepreneurs. We have over 600 chapters worldwide. We have an upcoming global conference, which is actually going to be in person this year in February, late February, early March. So if you are interested in going, please reach out to me. I do have some tickets available at a discount, and we are limiting capacity this year because we are still in a flux with, unfortunately, COVID. So it's not going to be as big as it has been, and that's on purpose, but we would love for more people in our community to go. If you need anything from Startup Grind, feel free to reach out to myself, my co-director, TJ. We'd love to help you and grow the economy here in Orange County. That's what we're here for. So without further ado, I'm going to pass it over to Shaheen to get started.
Thanks, Jessica, and thanks, Mollie, for being here with me tonight. So we're going to just talk about cap tables and dilution, but I think what I really wanted to do is understanding, sort of the angst that startups have as they talk about, diluting their founder shares. So just a little bit of a background, so we're all on the same page, right? When I get a new client, generally speaking, when they come to me from the very beginning, and they say, okay, let's say I need to incorporate because I'm getting ready for some seed funding, for example. Generally speaking, I set it up this way where I authorize 10 million shares, and I give 8 million to the founders, right? Through founder prices. And that additional 2 million I set aside for employees in an options pool. So although initially we can say the founders, right, they're the only ones there, they're the only ones that have shares, they have 100% of the company, we're already planning for 20% of the company to go to employees as a way of incentivizing them as we bring, because we can't pay market salaries, right? We know that when we're startups. So this is the upside, right? We take risk and we have some upside. So right off the bat, we're assuming we're going to get 20% over to employees, mostly employees. Let's set aside board members, advisors, et cetera, et cetera. Let's just call them employees. And then every time we do a funding round, in most cases, we continue to expand that pool. So now you're getting dilution from your investors, and you're getting dilution from an expanded options pool for your employees. And it kind of creates some angst for founders as they're going through this process. And I know Mollie and her co-founder, Hannah, have talked about all of this as they've kind of walked through this path themselves. So Mollie, I'm going to kick it to you. Why don't you tell us a little bit about your company, how you and Hannah started the company, and kind of take us at least to where we are today with your trajectory.
Sure. Thanks, Shaheen. So Hannah and I started the company in actually 2016. We launched in retail in 2017. So it was first the name of the
Mollie,
company.
Can you back up and tell us what your company does?
So yes.
Everyone who's out here knows what you're doing. Yeah.
When we first launched, the product was Hakuna Banana, which was a line of banana-based ice creams, all vegan, plant-based, no refined sugars. So, an alternative to dairy ice cream. And we started in retail in 2017, and we've since rebranded. So our company name is now Must.Love. But Hannah and I, as co-founders, before we even started the company, one of the things that we did, we've been best friends for 15 years. So I think we were pretty ready to work together, but had heard horror stories from friends, family, people who had started businesses together, to really take a step back. And we call it like our premarital counseling, where we
Yeah.
took a weekend and we literally talked about every single topic we thought could come up, or things that, uncomfortable questions. And one of those huge areas was how we looked at fundraising, how much we would want to dilute ourselves, even what our exit would be like. And obviously all those things have changed over time, but we just wanted to be on the same page initially. And so back then, our mentality, just from our own backgrounds and kind of what we wanted to build together, we were committed to bootstrapping as much as we could. We knew that eventually there would probably be a time at which we couldn't bootstrap anymore, just because of the nature of consumer products, super cash intensive, and just the landscape of it now. So many brands fundraise and get investment and grow at a clip that you can't grow organically. But at least from the get-go, we were really on the same page in terms of wanting to bootstrap. And part of that was because of the dilution question. It's like, if we raise $1 million as first-time founders, how much would we have to give up in that first fundraise? And how much room would that give us for later rounds? So we bootstrapped for the first 2 years. And then we really got to the point where we were transitioning from, we were local to Whole Foods. We were in a couple Sprouts farmers markets, but we were going from like, say 150 to 300 stores. And that it would have taken too much cash for just Hannah and myself to invest in the company. Because part of the question at that point is it, in terms of our personal risk tolerance, is there a point at which we need to diversify our own risk? Like, we're 100% it. Obviously, the reward is greater if we're still 100% owners of the company. But is that just from a cash perspective for our own lives? Is that something that we want to do? And so that's the time at which we started kind of the fundraise journey. And I'd say we still, had stepped back, had a conversation about what that looked like. And so we went kind of the slower route of doing a friends and family. We've done now a pre-seed and now a seed round. So we've done 3 rounds as safes, which Shaheen has really helped us put together and help fundraise at this point. But we've raised, at this point, we're nearing $2 million in the form of safes. And so it's not a small amount of money, but we also know the next round will probably be a Series A. So as we were raising each round, we had to think about how much the round would be, at what valuation, and then the implications of when those converted.
Okay, hang on. Let's back up and make sure everyone's on the same page with us, which is a SAFE. I'm sure everyone knows, but just in case, a SAFE is a simple agreement for future equity. It is sort of a convertible note notched down one level. So it doesn't, you don't accrue interest on it, but it effectively will convert at the time of a priced round. And you have some levers to play with. So you can offer a discount when it converts, similar to a convertible note. You can also offer a valuation cap, similar to a convertible note, and you can do neither. And I think what Hannah, or what Mollie is saying that she and Hannah did, was offer the value, like you had to think about a valuation cap. And so what that means, right? A valuation cap is the amount at which they would convert, like the best price they would get.
Mm-hmm.
And so I just wanted to make sure everyone's on the same page there, that's why that valuation question and the dilution question comes in at that point. And how you're kind of, so, okay, so you and Hannah had some conversations about that, and you decided it's best to sort of diversify risk. Like the risk reward is now starting to change, right? Right. And in order to scale at the pace and the clip that you wanted to scale at, it requires outside investment. So talk to me a little bit about, a couple things. Like I think there's sort of the emotional side of it, and then there's the analytical side of it, right? Rationally, you can say, this is what we need to do. But like, talk to me a little bit about the emotional part of it, where you had to kind of get ready to let others into your company and sort of take a piece of it. And did you put any parameters for yourselves on the types of money you would take, as far as knowing that it would dilute you?
So I think, I mean, we got to a point where it was pretty clear the amount of money we would need to grow to the next stage. Like, we were expanding nationwide with Sprouts, and that takes just a lot of cash to enter a new market in that way. There was no way, just even like we just couldn't have, we didn't have the cash to even do that. So at that point,
Right.
the answer was, it was made for us. But I think for me personally, it was on the emotion side. You know, I come from a family of entrepreneurs, but it, you know, they all were able to start businesses from scratch. Honestly, at the time in the 70s, 80s in the States, they couldn't even get money. So they were
Right.
finding small loans here and there, borrowing from family, because they couldn't find investors. But at the end of the day, they were able to build, sizable companies and retained 100% of that. So, in my mind, it's like, that's kind of the model that I saw in my own family and what I wanted for myself. But it's a different time, it's a different industry, so the dynamics are different, and that was something that I needed to swallow personally. I think between me and Hannah was probably more ready to take on outside funding. So it was really just us continuing to communicate that we were on the same page, because I think that's where tension can really build up with co-founders. And then once I decided, it was honestly like a sigh of relief off my back. Like, it would be nice to have money in the bank and us not scrounging around and figuring out where, how we're going to get payroll out the following week and how to fund inventory. But in the same way, we're trying to be as scrappy as possible with what we're raising, and figuring out, can we stretch that out as long as possible by financing our inventory, things like that. So it's not like we're trying to raise 5 million pre-seed and have like a huge round like that. Just also wouldn't be feasible for us, our company at our size.
So that's a really interesting point, right? So dilution, it's, for most companies in the startup space, that's going to be an inevitability, right? At some point, you're going to just need to scale, and you're not going to have the personal cash for most folks. But then it's sort of like, okay, at what pace do we dilute ourselves, right? How much money are we going to raise in any given round, at what valuation? So some markers that the boring lawyers in the room use, we'll ask clients to pull about an 18 to 24 month runway. Usually a client will slot in an 18 or 24 month runway, and it lasts about 12 when they're actually in the space. And the reason I often tell clients, like, book out longer, one is I know it's not going to last as long, but two is it takes a lot of energy to fundraise, right?
Oh yeah.
And I just don't want my clients, like, on an annual basis, just having to hustle for that investment funds. So better to kind of, once you're in the flow, think about what you need for the next 18 to 24 months and really try to go for that, and then see if you can either stretch that money out for that full time, because it's just such a time suck. And well, that was one thing I wanted to say. And then the other thing was, as you're giving out equity to employees, or let's say early employees, or on an ongoing basis, sort of pacing that out too, right? So so many clients who, not Must.Love, but so many clients who come to me and they're like, we were like having dinner and I told them I would give them X, right? And I think part of understanding how dilution impacts you is knowing, like, what is reasonable, and coming up with a strategy for, who's going to get what based on the amount of work that they're doing for the company, and having kind of a larger plan, so that as dilution's happening, it's happening like it's smart dilution, Is that fair to say?
Yes.
I'm assuming you all have had conversations about that too, about.
Yeah, I mean, I think I've heard a lot of stories from colleagues, founder friends, that especially with safe notes, it's like, well, it's not real yet. So they just start making safe notes, and but that converts, and you have to think about at the price round, what percentage of the company you've already given away. And so, I had just a quick and dirty spreadsheet of literally like buy round, what percentage, the cap, or the valuation, and what implication that was based off of Series A at two to three different prices, like valuation. So
Right.
at what point do me and Hannah drop below 50? Like, that's an important thing for us to note. And in terms of who we've brought onto our theoretical cap table, but future cap table, who is ending up with the largest pieces of the pie. So that was something that I set up pretty early on. And we personally also started with friends and family. So it was lots of different folks for little pieces. So at that point, you're not really concerned. But now that in our pre-seed, we've taken on more institutional folks, that question becomes much more important, because we've also heard horror stories of people that have honestly lost control once they get to a Series A. They need money, and that's the investor that'll put in more, but suddenly they lose control. So those are kind of the things to watch out for, even though you're in an earlier stage and think that you don't have to worry about those yet.
So two things that you bring up there, Molly. One is the pro forma, right? And I think that a lot of startups don't have that handy dandy spreadsheet kind of floating around. But I think one of the things I would say is, if you don't have a lawyer who can help you, there's some that you can pull off the internet, and I'm sure you can find them, but spend some time trying to understand how various levers impact your dilution, right? Then the other thing I want to say too is, oh, there you go. Rose says the proforma.com or .co. Perfect. Then the other thing that I wanted to say is, to Mollie's point, kind of smart dilution, right? So we want to bring on investors. We want to understand their kind of relative percentage ownership. And if they aren't going to be, if they're not going to be dumb money, meaning quiet money, then we want to make sure that they're, smart money and strategic. The worst is to have kind of what Mollie's describing, which is sort of this, annoying money, and they have enough of a say now because of the way the dilution played out. And that also gets triggered by things like pro rata rights and other side letter kind of agreements. So side letters are in a financing round. An investor says, yes, everyone has these set of rights, but I want a couple special rights as well. And we put it in basically a side letter agreement that gives additional rights to certain investors. It's typically the lead investor. So now you see the lead investor is already taking a significant chunk of this particular round, is asking for additional rights to take additional chunks of either this round and or the next round. And then quickly you can see how this investor now just becomes kind of quick, potentially an acquirer, right? And so you kind of have to be careful about that. So how have you guys managed that, Mollie?
Well, we're actually in the middle of it, which you are assisting me with. So the only
I wasn't leading you anywhere at all, Mollie.
It was a very good segue. We've only really had one earlier institutional that requested just standard pro rata, which we felt fine with, giving to them at the time. We are talking to someone right now, and we're pretty far along in terms of trying to close out our seed round. And initially they asked for, a particular term in a side letter that immediately gave me pause. And so I think at that point, instead of just saying yes, the smart thing to do no matter what is to just pause, even no matter how much you need or want the money, love the partner. like I immediately called Shaheen and talked to also a bunch of different founder friends to ask if they've encountered this. And I also talked to my other institutional investor, because ultimately we would have to probably grant them the same right. And we have a great relationship to them. So we asked, is this something you've seen in the past? What are your thoughts on it? And to get all this variety of perspective, because at the end of the day, Shaheen is always going to be the most conservative voice. That's your job as the lawyer. And so it's up to you to tell me all the pitfalls of why I shouldn't do that. You know, you have me and Hannah super excited about just getting this partner on board. But then it's going back to them and honestly saying what we did do is figure out, well, what is the reasoning behind why you're requesting this? Is there a different way we could get to your objective without having to fully give in to the thing that you're requesting? And I think the way they respond to that will also indicate what kind of partner they'll be, because immediately the investor said, this is why I'm asking for it. It's like, at this round, we aren't going to get enough equity for it to be meaningful in the way that we would want to invest in a business overall. And our concern is the next round, we would get diluted out by a lead or a larger investor, a CPG investor that you really want to work with. But my concern is, would that term scare off a different lead investor or someone who would want to come in? So it's balancing their interests with, you know, what the possibilities of what a future round could look like. And it's, you know, just being more creative in getting it working for both us and them. So that is how we've been approaching it. I will say we haven't closed their investment yet, but I think it's been a very productive process. And that also gives me insight that, you know, they're really wanting to partner with us, because if their reaction was like, no, this is the term, like you take it or leave it, we'd probably leave it, because it's, at that point, you're also setting the relationship up in a way that we have no really control, or we're not truly partners in this. So that's been our perspective, but it, you know, it really would depend on each founder.
Well, isn't it interesting? So we're talking about kind of founder dilution, but you also hear investors kind of worrying about the same thing.
Their own dilution, yeah,
yes,
exactly.
their own dilution as it speaks to their fund or whatever their fund, you know, principles are or parameters are, right? They have to worry about their own dilution. So to your point, at some point you're starting to balance, like you're starting in some ways, and tell me if I'm wrong, but you're kind of thinking less about, once you decide what the round is, you sort of stop thinking about how this is diluting you, and you're just now trying to close the round. And now you're navigating who wants to be the lead investor and how much everybody, what percentage of that pie that you've given up already is going to get cut in a certain way to make it sort of smart money for you, right? Fair to say?
Yeah. And something that also came up in our discussions with this investor is he was looking at our projections and what we expected our runway, like cash management, would be. And basically was like, based off of your projections or what I think the pace of your growth will be, haircut or not, I think you should raise X amount more, because if that gets you to 3, 4, 5 months extra runway to a larger Series A, or a point at which, you know, it's more interesting for me and for you, so you don't have to do a bridge or something in between, I think you should raise it now. And so that, I mean, he suggested that, and I took it back to the table and, you know, laid it out, because it's also like, well, I'm raising more at a lower valuation. Do I just try to hold out? Because you basically don't want to raise way more than you need, but you also don't want to run out before you're at a point where you're at an interesting valuation for the next raise. So that was an interesting dynamic, and something that, like, honestly, I'm working through right now.
Well, and here's the other thing that often happens with clients, not you, Mollie, but oftentimes with greener entrepreneurs, because they want to keep dilution down, they sort of artificially inflate their valuations.
Mm-hmm.
But then remember, you have to chase that valuation round after round after round. And the worst thing you'd want is to have what's called a down round. I'm sure everyone knows, but basically a round that is, at a lower valuation than the prior round. And then all of the anti-dilution provisions kick in, and now you're adjusting everybody's conversion ratios. So I think that's something you have to kind of balance out as well. It's sort of like this alchemy, right, of finding a good valuation for now to dilute enough, not too much, and then prep yourself for the next round, so that you can grow big enough to kind of dilute yourself a little bit more, and hopefully as you're building, that dilution comes down a little bit more and more each time. So for example, at a fresh round, at the initial round, when we're doing, let's call it a proper seed round, let's set aside safe conversions and things like that, but just if we start off with a priced seed round, what I tell clients is gauge for 20% dilution. And you're hoping that as you kind of go through your rounds, that's either sticks it at 20 or sort of maybe comes down to 17 or 15, or sort of starts to slide down a little bit as you get larger and larger. So that's kind of a benchmark for anyone. Just before we keep going, I want, like, Mollie and I want this to be interactive. It's kind of bizarre doing this on like not live and on screen. We're happy to keep talking to each other, but if anyone has any questions, I think Jessica said you can't actually speak, but you can type them in. So if you have any questions, like, interrupt us, we'll be happy to do that. The other thing that I think Jessica wanted us to talk about was cap table management. And I told Jessica and Mollie, I'm like, this is not going to be a commercial for Carta. Nobody's paying us to talk about Carta. It just happens to be the major platform that most of us use. I'm sure someone else will come up with something. Okay, good. Thanks, Rose. We'll get to your question in 2 seconds. So what we try to do is, what we try to do with cap table management is keep things as clean as possible from the beginning, because this is going to help you from a diligence perspective. So we'll just use Carta for an example, but look, back in the quote old days, we did it on spreadsheets. And when you're starting off, and Mollie and I have spoken about this, like, you don't need to spend thousands of dollars on a fancy cap table management. You can manage it with a spreadsheet fine. At some point, it's going to get too clunky. And I think the big thing that cap table management software and apps do is help you manage the compliance when it comes to handing out equity. So, or incentive equity options and stock options and stuff like that. So at that point, I think it's really important to get a proper software, and use a proper cap table management system to handle all of that, so that nobody internally is trying to remember, all the compliance around the equity pieces. Okay, there's a few questions. So, Jessica, are you hopping into
Yeah.
Okay.
To help you with the questions. Okay.
Thank you. I'm watching them come in, and I'm trying to talk and watch and
That's okay.
and it's like funky, and then yeah. All right.
All right. So Rose would like to know, how much equity do you give a new co-founder, like a CTO or a CMO?
Oh, this is a great question. So the question is this really a co-founder, or is this just an early stage, early stage kind of key employee? Because it's different.
So how would you recommend figuring out which is which? So where do you say, okay, you're no longer a co-founder, you're now just a key employee?
Yeah. So a co-founder is, someone who's there with you in the garage, coming up with the idea and pulling out money from their pockets to go down to Home Depot to get the first hammer that you're going to use to build the widget, right? At that point, you're really talking about a very different thing, both in terms of what you all are getting, right? Whether it's 50-50 or 40-60, or if there's 3 co-founders, it's 30-30, 33-33, whatever. You understand what I'm saying. But and you're getting those shares at a founder's price, right? fractions of a penny. So there's potential for tremendous upside, but you're taking a tremendous amount of risk, right? You're not going to give that kind of upside to someone who's coming in. I think Rose said later stage valuable CTO. So if I'm understanding that correctly, it's like we've already built the company. Now we are in a position to hire, right, a full-time CTO. The CTO wasn't there from the day one. CTO is super valuable, but wasn't there from day one. So isn't going to get that kind of equity that founders were getting, and certainly not at a founder's price, right? So now you have to come up with, basically, it's an HR issue, Rose, because what you're trying to do is build out a strategic plan for all of your C-suite employees, right? Because what you want is your CTO, and let's say you have a CMO, obviously your CEO, and whoever in that C-suite is going to have relevant, relative percentages. They're all going to be looking at each other like, what did I get? And usually what I tell clients is, make a triangle and have bands, just like an HR comp plan. And usually in the C-level suite, we're talking, anywhere from 1% to 3%. And you're not expecting there to be 10 people at that C-suite, right? And they're going to get diluted, right? So they're going to get 1% to 3% of options at hopefully a pretty good strike price. Those options are going to be subject to a 4-year vesting schedule in all likelihood. That'll be dictated in your financing documents. And then at the time of an acquisition, that's fine. They can reap the benefits of their hard work. But I think that's the scenario you're talking about, Rose, and that's what I would recommend. Yes. Okay.
All right, great. So Sergey has a question about Tiger term sheets.
I wish Sergey would help us understand what a Tiger term sheet is. I've not ever, Molly, Jessica, anyone, what is a Tiger term sheet?
I have not.
I've never heard of it.
Yeah.
I wish Sergey could pop on.
Sergey, do you want me to pop you in and maybe you can give us some understanding? Let me know. I will pop you in. Just to hit me a message. But Sergey did have another question. Can you explain forward and reverse splits? Why issue millions of shares individually when pre-IPO do reverse splits?
Yeah, so really it just comes down to the math of the deal structure, Sergey. So, okay, let's just get everyone on the same page. Like what is a split and what is a reverse stock split? So basically a stock split is Must.Love issues Mollie 100 shares, and then decides, shoot, it doesn't really feel good to give my, CTO 5 shares, which is, about 5% of the company, but it feels like junk to give out 5 shares. So I'm going to do a split, and I'm going to split it times 1,000, times 1,000,000, whatever. And it, that's an emotional reason, but a lot of times we'll do it because the math just works out better for us. We just need more shares to be able to kind of split it up better for the cap table purposes. Reverse is the opposite, right? We've now authorized 200 million shares. And sometimes this happens. Somebody authorizes 200 million shares. You've got this huge cap table floating around. And then you have to register in a state that taxes you based on the amount of authorized shares you have, not based on the value of your shares, right? I think Virginia is one of those states. And you get this horrible tax bill and you go, shoot, let's do a reverse split and manage taxes that way. So that's why a lot of times we start with 10 million because that seems to keep a good pace on tax issues. But that's basically what a regular split is and a reverse split is. And the same goes for the follow-up question, why issue the millions of shares and then the pre-IPO do the reverse split? It's generally the same reasons. There's underwriters making decisions about what's the best way to do the deal structure.
Okay, so Sergey got back to us. So Tiger Global gives startups a ton of money, outbidding every VC, and demands no board seat.
Okay, so what was his
referring back
question?
to, have you tried demanding a Tiger term sheet?
Demanding, so this is probably a question for you, Molly. Have you tried demanding that someone give you money but no board seats?
We haven't given out any board seats at this point, but I also no one's asked us, but we would say no at this point. But also, like, I'm not, I haven't felt like I've been in the position of demanding anything, honestly, where, I mean, it's like your stage of the company, what types of investors you're looking at. Hopefully, when we're at the next phase, we can start being much more picky about who we're talking to, et cetera. But at this point, it's been like, you want to give me money? Sure. Like, what do you want from us? So I'm trying to balance that with being smart, but it's definitely, that's what have been my perspective.
And it's excruciatingly hard, right? Because you need the
terrible
money to like make payroll or get inventory or whatever.
Yeah.
But I do want to talk a little bit about dilution in a little bit of a different way. So not so much the cap table, but dilution of control, dilution of power. And that can happen both at your cap table level, and we've already talked about that, but it also can happen in the boardroom. And I've seen that happen, where you give up too many of your board seats. And I would caution everyone, when you're doing these term sheets, what I like to end up with for my boards at some point, as at a point where they're kind of big enough, is a 5-person board. 2 are represented by common, 1 is the CEO, and 2 is represented by lead investor. If there's more than 1 round, you could pick an investor from each round. You can kind of honor the fact that there was a first round and a first lead investor that really was sort of backing you and kind of singing your praises, and then everyone else decided to join, right? So you can honor that by keeping that seat for them. And then at the next round, the next person gets that next seat, for example. And I would hold true to that. Never, ever give up your majority position on the board. I think it is nice to have your investors on the board. I think it makes for a good gut check when you're making bigger decisions and you're playing with their money now, right? That they have sort of transparency in how that's moving. But so many times I've had clients who've held on to their board majority, and it's been pivotal. Now, if you have board majority, but you give up shareholder majority, even by a fraction of a percent, while it's true that day-to-day operations can kind of truck along, on the big decisions, because of the way financing documents are set up, your shareholders, your preferred shareholders, are going to have basically what's called protective provisions, effectively veto rights for all the big fun things that you want to do, including exiting and how you would exit. And so you have to really watch that. Again, back to dilution. You have to watch, like, I've kept board control, but on the big stuff, I have 1 shareholder who can just hold out and say, no, I don't like that deal, or I want to do a deal that's more beneficial to me, in terms of, I don't know, timing or return on investment. And founders get stuck, and that I've seen that, and that's really, it's heartbreaking, because you're just pulling your hair out year after year after year until finally they turn the key and they say, okay, well, we can do it now. And it never usually works out as great for the founders from that perspective. Any other questions?
Yes. So Lulu has a question. Her question is that key employee number for C Corp or LLC? So is there like a key number, and is it total percent of total equity or founder's percentage?
I don't think I understood the question. Say that again. The key employee number. What does that mean? The key employee
I'm thinking was when we were having the conversation around the CTO. So those key employee numbers for the corporation or LLC, is it a percentage of equity that they should hold? And same thing with the founders. Is there a key percentage those people on your C-suite should hold? And what is the key percentage for your founders to hold? Lulu, if I'm not correct, please.
Yeah, so it differs for each company, but let's take a look at it, right? So let's just assume what we started with, that initial kind of setup that I do for most of my clients, right? I give 80% of the company to the founders, and 20% we reserve for employees. Now you have to look at employees through, call it series, seed series, your first price round. So who are you hiring in your first price round? Oh, Lulu's coming in. Okay. Um, who are you bringing, who are you bringing into the company as employees from the time that you set up until you do your price round? Because potentially you have 20% to play with. And so I want you to think about it from that perspective, but then don't issue anything yet. And then also think about what is your long-term strategy for employees. Don't think about like when you build out like hundreds of people, but those key, probably, in most cases, it's like the key 50 employees, right? That you're going to need at some point. And you're going to pace them out over time and think about, okay, well, my C-level employees, yes. So let's say you have like 5 C-level employees in a 20% equity pool. Do you want to give them roughly 5 to 10%? That depends on who else you have to hire initially and how much you want to reserve for all of them collectively, right? So maybe your senior directors and stuff. And again, in an early startup, you're not having layers and layers of employees. You're not having a really, vertical sort of org chart. It's pretty flat in the beginning. So that's fine. And a lot of times what'll happen is you'll kind of hire your key, those kind of initial key folks, right? We can maybe give out another 10% of the company and reserve that 10%, knowing we're going to do more hires, right? After the seed round. And when we have to bump that seed round, so what's going to happen is your investor in the next round is going to go, I want you to bump this back up to 20%. You've given 10% away, you've retained 10%, and bump it up another 10%. And now you're going to have a little bit from the first round. We're going to increase it in this next round. And you'll kind of replenish, and you can kind of reset how you're going to do this next phase of option grants. Hopefully that answered her question.
Yeah, Lulu, let's see if I gave you presenter mode access. You should be able to jump on and join us. Okay. So while she gets on, I did have a question from a founder who was not able to join tonight, but they wanted to watch the recording. So they are being presented with warrants. So the company has already raised. The company needs to hire this person, but because the company is like stagnant, and the company, from the new person's perspective, they're not a founder, but the new person's perspective, they did a fundraise a while back, but it was overvalued, and they don't want to pay the significant tax consequences on getting into the company now with a significant piece of equity. So the company is thinking about giving them warrants instead. So what is the difference between options and warrants?
Options are pursuant to the equity incentive plan, and they fall under certain tax provisions. There's compliance around how much equity a person, or how much equity a person can be given in a year. There's a tap out at 100 grand value per year. So that doesn't mean your equity grant can be worth $1 million, but what you're actually able to vest as an incentive as a ISO is capped in any given year, and then it'll kick over into what's called non-qualified stock options, which means it's less tax advantageous. And so warrants kind of is outside of that box. So although it acts very similarly to options in terms of how it moves, right? You're given the right to purchase so many shares of common stock, and generally speaking, but so many shares of common stock at some certain strike price, right? My guess is that strike price is probably pretty high. And they're not super thrilled with that idea, because in order to purchase that, it's expensive. But I would say that generally speaking, warrants usually have a term of 5 years, sometimes 10. You don't necessarily have to exercise your warrants until and unless you see a liquidation coming up, right? And then you have to kind of work around what's the best tax implications for you. Do I exercise my warrants and try to hold on to these things for a year for capital gains purposes? And it becomes kind of like a different exercise. But yes, it's tricky. And a lot of times the question you can, anybody coming in at a later stage who wants shares, not options, but significant chunks of the company, but now the valuation's gone up, et cetera, et cetera. The question that you can ask yourself is, are you bringing any intellectual property into the company for which you can, quote, pay for your shares? So you can pay for shares in a few ways: cash, right? The forgiveness of debt, or the exchange of property. It can be real property, but it can also be soft property, like intellectual property. So if at any point you're coming in with that kind of contribution, you can use that to pay for your shares, and then you'd be able to get them outright. Maybe subject to a vesting schedule as they're restricted, but there's Lulu.
Oh, we had her and then we lost her. She might be jumping back out.
Someone had a question, Jessica, Rose had a question about having an advisory board member subject to the equity plan.
Oh, sorry, Rose. I totally missed that. Yes.
I see it both ways. Usually we give advisory board members warrants. On occasion, we'll give them options if it's really a small amount, because you don't necessarily want to pull from your employee pool for advisors. And usually advisors get something very nominal. It's not like you're giving them a lot, but okay. Any other questions? We have, I guess, a few more minutes.
Yeah, there we go. All right. Lulu, go ahead and unmute and you should be good to go. We can hear your background. Can you hear us?
There we go. How about now?
Yes, we can hear you.
I just hooked up my microphone. So my question is this. I'm the only founder. I'm 10 months in, right? And I have one investor, and I've done 3 little rounds in them, and we're prepping to get the next one, which will be a little bit more. I really appreciate knowing to set for 18 to 24 months, because we were looking at 9 to 12. So I appreciate that. But we're looking at key employees right now, and the investor has a percentage of total equity. I have 2 companies. One is the parent company for this project. This project is baked out into a separate LLC, because anyone that comes in, they're not going to be investing in the other company, because I'm doing multiple projects under that. But when it comes to key employees, so we talked about numbers of percentage of my position, right? Because I don't own the full company anymore. And I was going to do 20%, and then over across the key employees. But what I don't understand is, how do I give 5 people 20% of my position and how do those numbers work? Does that mean they have 100%, or is it 20% total? I just don't know how it works. And I'm actually getting ready to execute a contract right now with my number 1 key employee. And then I have a couple others that are going to be going on there as well. So just making sure I'm not screwing myself. But I am also want to be generous and really appreciate my key employees, because their commitment level is high and they're driving hard. And I want to reward them for that.
So Lulu, if I'm understanding correctly, you want to give them, let's assume you own 80% of the company. You want to give them 20% of the 20 of the 80. Is that what you're asking?
I own 90 and I want to give them 20% of my 90.
Right. So you're asking, is that appropriate?
Well, I'm asking, how does that happen when you have 5 employees? Say, I hear you on the tiers, like say 20, 15, 10, 5, right? But how does that happen when I have 5 people at 20% of my position? Does that mean between all of them, they own 20%? I'm trying to understand the math, because this is really new to me.
Yes, that means between the 5 of them, they would own 20%.
Okay. So, and how do I explain that to key employees, or is it on them to check their legal paperwork? Because I don't want them to feel like they got 20, the next person got 20, and they're all splitting 20, and then they feel screwed over. I'd like to be proactive on that.
I don't think your agreement's going to say you're getting 20%. I think your agreement, and I don't know how I think you said it's an LLC, so maybe it's membership interests and not units. So it's based on percentages is what I'm guessing.
Yeah, percentage of my percentage. Yeah.
Yeah. And so really, I mean, this is kind of true legal stuff, Lulu. So
That's fine.
I'm going to do my disclaimer of I'm not giving you legal advice on a
It's
Zoom
okay.
call.
I have
But
I have a
here's-
full
here's-
legal team,
here's
so
what
I'll ask
happens.
them.
No. Here's what happens, Lulu, is really what happens is you actually do if truly what's going on is you're giving your interests to someone else, the grant actually happens from you to your employees. So what we're talking about is dilution, where you kind of continue to expand the numbers that are available and give them that amount, but you're talking about pulling out of your own ownership. And so it's structured a little bit differently. So what you're going to end up doing is, for example, if you have 5 people, they're all going to get effectively 4% of the 80 that you own or 90 that you own.
Okay, that's what I was trying to understand. I'm just learning. This is new. This is my 7th company, but my first one investor back, so I'm lost. I'm lost and lost and lost again. So I'm grateful for y'all. Thank you so much.
All right, great. I'm glad we were able to help.
Thank you.
All right. So we only have about a minute left. Any
I'm
last?
Let Mollie say whatever she wants to say. It's something encouraging and inspiring, Mollie.
Yeah. Any last minute advice?
Tell people not to get downtrodden by the dilution game.
Yes. I know like before you had mentioned something like, hey, there's a free version of Carta. Like, what are some tips, some tricks, something that you could say, go do this, don't do this, and just give some, parting advice?
Well, I would say on the fundraising thing, carousel, I feel like now I've literally been fundraising for 3 years straight. And so to Shaheen's point, if you can build in time of rest, that would be really important. Luckily, I have a co-founder. So the other thing is most founders will say fundraising feels like a full-time job. So a lot of my responsibilities have gone to my co-founder while I take on the fundraising responsibility. And so if you're a solo founder, just giving yourself the time and space to dedicate to this, because if you give yourself 6 months to do it, it's going to take 8 months or 9 months. And just be prepared for that, honestly. And then also just be really kind to yourself in terms of all the no's that you'll hear, because the way that I approach it is, there's investors that are looking for specific things. And if you're not the one, that's fine. It's just not the right fit. Don't be so hard on yourself. And for me, what has been really something that I've learned over the 3 years I've been fundraising and talking to tons of different people, if early on in a conversation, I feel like it's going to be a no or it's not the right fit, just, sell yourself, sell the company, but also at the end of the day, ask them for a warm intro to someone else, because they're more likely to feel okay with saying no to you if they are like, but I have this X, Y, and Z person to talk to. And they don't feel as bad for saying no, because for the most part, people don't want to do that. And then, warm intros are better than cold. So then you already have a lead to the next person you can talk to. So I think just figuring out ways to allow yourself the rest. Like, I honestly had to take a break from fundraising because I started and the COVID hit. So I was like, I'm just going to go back to trying to figure out how to run the company and then step back into it. So it's not a linear thing. And also find friend founders that you can really lean on in terms of the emotional support, because that's a huge part of just grinding through fundraising. Hopefully that was inspirational. I don't know.
It's true.
Yeah, so
truth all over it.
And good luck. That was so sweet. Thank you for doing that.
Shaheen, any last minute advice, anything that you want to leave our founders?
Should I share my screen so that people have your contact?
Follow-up questions, folks. Look, I don't generally make PowerPoint slides, and look, I did it. Mollie offered to do it, and I was like, I can do one slide with our logos, and I did it. So, I feel like it looks pretty good, actually.
It does.
So
that's great.
Anyways, Mollie and I are happy to answer any questions, or if you just want to connect with us, we've given our emails out. So Mollie's Mollie at Must.Love. And please, like, check out their yummy treats. They're so good. And it's personally, it's super exciting when I see it in the store. I'm like, oh, that's my client, and I'll take pictures and get really excited. And then mine is Shaheen at esselaw.com, ESSELAW.com. So feel free to reach out to us. Consider us part of your community. I think we're both here really just, you know, we just know how hard of a grind it is, and we just want to be able to support you all. As far as my last tip, I'm just going to say at some point you're going to need a lawyer, and please get a lawyer. Like, don't stop pulling things off the internet. Like, I know that's how it goes in the beginning, and often I will tell you, I'm like, just go get this off the internet, or I will give things to clients that aren't ready to pay for a lawyer. But at some point you're going to need a lawyer, and then just go find somebody that you really can connect with. Most of my clients stay with me from inception all the way through exit. And I think you have to think about your lawyer in the way that you would think about a co-founder. Like, can you trust this person? And are you going to be interested in working with them and kind of growing with them and being kind of married to them in an ideal world? I know it doesn't always work out like that, but that's the way I approach it. And I would highly recommend that you approach it that way. And use your lawyer that you find who's like that, not just in a legal capacity, but bounce things off of them, right? Like, what you want in a startup lawyer is someone who's going to give you good legal advice, yes, of course, but also someone's going to take a step back and say, okay, here's the law, right? At the end of the day, we're running a business, and what do we need to do to make sure that the law is supporting what you want for your business strategy? So look for all of that, and don't be afraid to interview a bunch of lawyers. And what I tell everyone when they talk to me, I always say to them, talk to like four other attorneys, and find the one that you really trust, because that is going to be so important. Because you want to be able to like close your eyes and like, when you're, you know, okay, when I call my lawyer, they have my back in the best possible ways. That's my plug for lawyers. We often don't get plugged, but I'm plugging us.
Yeah.
I will also personally plug Shaheen. She is a wonderful attorney. So.
Thank you.
Awesome. Well, ladies, thank you so much for joining us this evening. Thank you, everybody who joined us tonight. If you have any questions, feel free to reach out to them, or feel free to reach out to me. Love to help you in whatever way I can. So until next time, I will see you all later.